Investors cheered last month's cooling U.S. inflation data as an encouraging sign for the economy's recovery and a hint that we may be nearing the end of the Federal Reserve's rate increase cycle. But our guest says inflation could actually get worse before the year is done, and markets may be in for a shock. We want to welcome back in Wells Fargo, Darrell, Cronk with us now. So let's do a deeper dive of this. You kind of teased this out. We have some notes that you shared with us. We know inflation cooled, but your take on this is not so fast, basically, in terms of how we interpret this.
Yeah, if you look at past inflation cycles, right, and I think it's true of this one too, is you typically have a quick rise in inflation. We saw that last year, peaked at 9% on the CPI in June of last year, a quick fall in inflation, and then often it bumps along in a kind of a consolidation phase, and then it rises again. That's about how all of them have happened. What's interesting is, okay, you start breaking down what are the components that drive inflation, right? So we saw inflation drop nicely last week, and CPI came down from 4% of the headline to 3%, right? If you look at the back half of the year, you say, okay, is that trend going to continue? Which I think markets have bought into, right? This immaculate disinflation, and we're just going to go down to the Fed's 2% number and stay. But think about it this way. Just in the year-over-year comparisons, which is how we measure inflation, the rate of change, you need oil prices to be at $70 to keep inflation flat. Oil today is at 80, right? So it needs to come down. Gasoline futures and prices are up 20% in the last 60 days, right? So you think about inflation at the headline number, energy and food, right? And then I get into the core number, which is still sitting at 4.8, way above where the Fed wants to be, right? What are the drivers of core? Shelter, housing, right? We just talked about housing and the strength there. So you need the housing market to kind of roll over. You need wages to roll over and labor to roll over, which so far has been sticky and hasn't happened yet. So I think the risk here, and again, it's a risk, is that in the back half of the year, inflation could actually tick higher. It's not going back to 9%, but it could go from 3% back closer to 4%, which then has the Fed in a very different position. The Fed is not done in July then and needs to do more work later this year, candidly.
Even if it doesn't tick back up, even if it stays around where it is right now, we've talked to a number of investors who have suggested the market is wildly over-optimistic in thinking the Fed is going to be cutting next year because of a drop in inflation. It sounds like you're in that camp as well.
Yeah, I think it's tough to make the case for big, massive cuts. You reverse engineer that argument and say, why would the Fed aggressively cut when they've been so diligent and so resilient on the inflation conversation?
If the recession arrives and inflation goes way down.
Yeah, I mean, basically the Fed would have to do quick and emergency cuts if the economy does the Thelma and Louise right off the cliff, right? And none of us want that, and we're not predicting that, but I'm just saying that's the recipe for why the Fed comes back aggressively and says, wow, we've got to reverse course and add stimulus back into the economy. Right now, they're talking about still tightening policy, not easing policy. And the market has perennially got this wrong. The market has been pricing in cuts, and keep pushing that out on the calendar. Now it's pushed out, if you look at Fed funds futures, out into kind of mid-2024. So
obviously the vast majority expect next week that we're going to see a hike. But many industry experts that we talk to think it's kind of going to be one more and done. You're not in that camp, I'm guessing.
I don't think so.
Is it a to and through?
Yeah, I think it's more that, to be honest, Diane, because, again, the data just doesn't suggest that that's going to be the case. And what's interesting, and this will be an interesting case in behavioral finance or psychology that will get studied at business schools for years, right, which is the Fed has never wavered on their message, right, for the past 12 to 18 months. Powell has been resilient in saying, look, we are going to see this through until we get to 2 to 2.5%. Even if you assume inflation doesn't tick back higher, like we just talked about, 3 to 2, that last mile traveled is a really hard mile. You've got to tighten policy aggressively even from here to get us to 2, in our opinion, unless you drop into a recession, which would be disinflationary or deflationary. So we think the Fed probably does have more work to do. That's not priced into the market today, right? The market has to reset that. And that's going to probably create some volatility in the back half of the year. So here at mid-year, we'd kind of fade this big move in equities, this 16, 17%. It's been all on multiple expansion, nothing on earnings growth, which has been well documented. So, what multiple do you want to pay for the next dollar of earnings? Do you want to pay 21, 22, 23 times in a slowing growth environment and an environment where policy is still tightening? I would be careful there.
So it sounds so. You're saying you think that stocks are going to come to that realization. What's going to cause them to come to that realization, right? So what would change? The momentum is clearly the upside.
It is. The pain trade is to the upside.
Yeah. What's going to change that?
So what will change that will be inflation and Fed expectations. But more importantly, everybody talks about what the Fed's going to do with Fed funds. And, there's been some out there saying the Fed will need to take this to 6% or possibly even higher to ultimately arrest inflation. What's interesting, if you go back and watch market action over the last 12, 18, 24 months, every time the 10-year Treasury, the long side of the curve, has gotten above 4%, it's gotten really hard on equities. We just experienced that earlier this year. We experienced it in October of last year. When you drop below 4, it's kind of party on, right? And everybody just believes that, that low interest rate environment on the long side of the curve, which is pegged to growth and inflation, tells you that, the Fed has done its job and they've won the war. And we're just not so convinced. And history would be on our side of that, which is it's not just easy to arrest inflation once it goes higher, right? Like I said, it goes up quickly, comes down quickly, and then often has resurgence periods of time. So if it were that easy, we'd have heroes for past Fed chair people, right, who have done this miraculously, when the only one we probably lift up is Paul Volcker, who took interest rates all the way to 20%, right, to finally arrest inflation.
Yeah, I think people forget how painful
Yes.
it was to stop inflation then. Darrell, thank you so much. Really
My
interesting
pleasure.
perspective.
Yes,
Darrell Cronk is Wells Fargo CIO of Wealth and Investment Management. Thank you.